If you're in your 20s and wondering how much income you actually need to buy a house in Arizona, this video is for you. Most people either overestimate it or underestimate it, so let's break down the numbers. Before we talk about income, we need to understand this. The lenders don't approve you just on your income alone. They approve you based on your debt to income ratio, your income stability, your credit score, your monthly expenses, and how much capital reserves you have. The better question isn't how much do I make, it's how much do I owe. Let's use a real example. So if you're buying a home for $400,000 and you use a 5% down payment, which you can qualify for, your down payment is going to be $20,000. So that's how much you're going to need as your down payment to qualify for your home. But I'm not just going to let you think that that's all you need to buy a home. There's going to be closing costs, other costs when it goes into buying a home. But what's most important is not just the purchase price, it's going to be your monthly payments. It's not just your principal and interest. Yes, you're going to be paying your principal, which is the amount a month that you're paying for your home, and then the interest on top of that. Your all-in monthly payment usually includes, outside of your principal and interest, property taxes can be put in there, homeowners insurance, HOA if that's applicable, and then PMI, so primary mortgage insurance, if you're under 20% down payment. So on a home, around $400,000, depending on rates, taxes, and structure, you may be looking at more about $2,600 to about $3,100 a month in monthly payments. And that's not exact, that's just a realistic range and in the ballpark. Now, this is where income comes in. So we'll go through a few income scenarios. Most lenders want your total debt payments to be around 40 to 45% of your income. So this includes mortgage, car payments, student loans, your credit card payments. Those are your expenses in your debt. So if somebody who makes $100K has a high debt to income ratio, which means that their expenses are really, really high, compared to someone who makes, say, lower, so $70K, but their debt to income ratio is lower, which means they have more controlled lifestyle. The person making $70K, because the gap between their income and their expenses is larger, is going to be the ones getting the house, not the $100K earner. So I want you to know that it's not just about how much income you make. If you're someone who thinks that I can't buy a house right now, I need to make more income, maybe you're not as far off as you think you are. Maybe you just need more savings, obviously, but your debt to income is pretty controllable and you have a good credit score. So maybe you're a year or two away, maybe when you thought that you needed to make $30,000 more on an annual salary base. Just keep that in mind. This is why structure is more important than salary alone. Now let's talk, cash needed for closing. It's not just the down payment like we already discussed. The money you need to bring to closing can be roughly between 2 to 4% of the purchase price, depending on the structure and whether you can negotiate seller credits. $400,000 home, that could look more like between $5,000 and $15,000 dollars just for closing. So your total cash is going to look like down payment plus your closing costs and then plus your reserves. So you want to have a buffer zone. This is why planning matters and not rushing. If you build a plan and you're committed to it, you can get to it not only faster, but you'll be much more comfortable and safe than someone who just rushes into ownership or doesn't really know what they're doing. What stops most people? It's usually not their income. It's usually lifestyle inflation, not having a savings structure and budget. People don't realize how much money you can save annually. If you start saving every single paycheck month to month, your annual returns can be thousands and thousands and thousands of dollars. High fixed expenses, again, it all goes back to your lifestyle inflation. No clarity in timeline, preparation, strategy, timeline is very, very important and how people actually start to make the steps and move the needle. You don't need to rush ownership. You just need to be in position for it. Now, here's how I would think about it if you were thinking about owning in 2 to 3 years. Just follow this strategy. Again, what I'm about to say here doesn't mean it has to be you, but if you're close and similar, follow this strategy right now. If you can consistently save $800 to $1,200 a month, that's roughly $10,000 to $12,000 per year. In 2 to 3 years, that's what you need. You have $25,000 to $30,000 a year saved, right? That's how quick it could happen if you plan, build a strategy, and start to restructure your saving. Now ownership actually becomes realistic for you, not rushed, not emotional, but strategically positioning yourself. short term for long term benefits and for financial freedom and flexibility in your future. In this time, that also lets you improve your credit if you need to improve your credit, lower your debt, stabilize your income, even grow in your income. I'm not even talking about growing in your income here. I'm talking about just saving more and then understanding your loan options and what strategy you want to actually get into ownership. You don't need to buy at, say, 22, 23 years old. You should know if you want to buy at 26 years old. Bottom line here is ownership rewards preparation, not impulse. If you're in Arizona and you want to know what this could look like for you, I'm happy to walk you through this. Even if you're not in Arizona and you're in a different state, feel free to reach out to me. But if you're in Arizona, we can actually make this plan happen for you and make it into reality. Even if you're just 2 to 3 years out, positioning is very, very, very important. Guys, if you're in your 20s, even in your early 30s, you have the future right now in your hands. Don't let it go to waste. Think about the flexibility you can have in your future. And remember to think long term.